So I'm going to start out with, I know everybody wants to know what they can and cannot write off on taxes. So any guidance in that way? Or should they form an LLC or anything like that to protect them?
Yeah, that's a great question. So I guess first and foremost, if you're just fishing as a hobby, that's going to be a lot different than if you're fishing as a profession, or at least you're trying to make it a profession. So forming an LLC, that can be a little bit of a misconception because you actually don't necessarily need to form an LLC to be able to write off your expenses if fishing is a business for you. The LLC is really there to give you, liability protection. It's more there for the legal side of things. But as far as taxes go, you can operate as a sole proprietor without even creating an LLC, and you can still deduct any of your business, your fishing expenses that are business related.
Yeah, so we have clients all over the U.S., some in Canada. As far as taxes go, we can work anywhere in the world.
Okay.
If we're doing audits, like a financial audit, then we have to be licensed in every state.
I know we had Alvin from the American Angler Outdoors Network say good evening. Alvin's a good friend of ours. He broadcasts our podcast on the American Angler Outdoor Network. Great friend of ours. So
yes.
Good evening now.
Nice.
But me and John's kind of the same way. We're kind of weekend warriors. So I know we're kind of limited. We don't buy a whole lot of stuff. We don't have, a boat and, keep up with mileage and all that stuff. We just fish kind of local, but being a kind of a weekend hobby, I guess you'd say. What's your suggestions of anything on that, or is it kind of limited to a certain amount?
Yeah, great question. So kind of diving back to your LLC question, I did want to mention that sometimes creating the LLC ultimately can be a good idea later down the road for taxes. And I'll dive into that after this question. But for you, if you're just kind of a weekend warrior, but it's more than just a hobby, and maybe you've got sponsors or you've got some income flowing in from this, then yes, you want to really keep track of anything fishing related, and that can be a deduction. So obviously your tackle, rods and reels, mileage is a big one. So if you're driving to and from tournaments, different lakes to fish, keeping track of those miles. When it comes to those auto deductions, we can either take the standard mileage deduction, which for 2024 is going to be 67 cents per business mile. So if you drove, 30,000 miles in the year, but only 10,000 of those were business related, well, we would take the 10,000 multiplied by 67 cents a mile. And that's a pretty nice deduction right there. That's $6,700 right off of your income from the fishing, business, or sole proprietorship.
Right.
But yes, anything like that, even meals, if you were to meet up with maybe another, fisher and talk business in some way, whether it be the podcast, whether it be meeting up with some of your sponsors and you go out to a meal, then you can deduct that meal, and you get half of that. So you get a 50% meals deduction for any business related meals.
Nice.
And then some other things that people often don't think about, you can actually deduct things like your internet bill, your cell phone. Now these things would need to be at their business percentage. So if you can't justify that it's 100% business use, that's okay. You could still allocate 10%, 50%, a certain amount and deduct that. And then another big one that people may not know about is the home office deduction. So, I'm assuming that if this is a weekend warrior type of side gig, then you're going to be probably doing a lot of your work from home and from a home office space. So so basically what needs to happen for that deduction is you need to measure the square footage of that area where your home office is, and it needs to be used for the business exclusively. But let's say it's a 10 by 10 room, that's 100 square feet. And then you divide that by the full square footage of your home. So maybe your home is 2,000. So right there, you're getting a 5% multiplied by, your mortgage interest, property taxes, homeowners insurance, utility bill. We can even take a small percentage of depreciation on your home. So the value of your home over time times that ratio. So that's a really good one that a lot of times people don't even think about.
Well, I would add, a lot of people think that I didn't make money at this business, so I don't need to file a tax return. I don't need to report it. But if you have, a side gig of fishing and you make any money from that at all and you're in it to make a profit, you can write that loss off against your regular income. So a lot of times that's worth keeping up with, even if you're not profitable. Now you do need to have the intent to make a profit maybe in the future, but if you're losing money on a side hustle, that's a great deduction as well.
Yeah, that's a great point, because some people might think, hey, I'm losing money. I wouldn't need to pay tax on this anyway. It's too much to keep up with. But if you really take the extra time to keep up with your miles and the costs of your tackle and rod and reels, that stuff adds up. And so if you can show a loss on your tax return, yeah, that can potentially help you get a refund if you have a W-2 coming from your main job. And then at that point, that refund can be reinvested into your fishing side gig, And so definitely worth keeping up with.
Okay.
Oh, cool deal.
Guy Cromp says hello and have a great evening.
Hey, guy.
He's a guide by me.
Awesome.
Kevin McGibney, he's a owner of K&K Customs Electronics and aftermarket boat equipment. Great podcast topic. Thank you, Kevin.
Thank you.
Another question I had was, most fishermen don't become pros right away.
Right.
Okay. So if I've been fishing for, say, 5 or 6 years and I have fishing rods that I purchased years ago, can I sell them to my business to claim them off my business?
You wouldn't sell them to your business, but you can enter them into your business. So let's say you've fished for 5 years, you've got a garage full of tackle, equipment, boats, all of it. And then you say, okay, January 2025, I'm starting a new fishing business. I have an intent to make a profit. All of that equipment is contributed to the business at the lower of fair market value or cost. So,
okay.
So probably fair market value. Probably cost.
Yeah, I got you.
Yeah. Or we can go on eBay and find the highest priced item and say, yep, that's that one.
Yeah.
So
it is
helpful to have something like what you said in eBay. And, when you're making that list of everything you're putting into a business for support, have listings like that.
Yeah, that's such a great question, though, because so many people, we see this a lot. They'll say, you know what? I've been doing this as a hobby for a while, but I'm to the point where I think I can start making a little bit of money doing this and make this a business. And they don't realize that all those past expenses they had can be, contributed to their business as a deduction. So definitely worth going through and coming up with that list if it's your first year.
Okay. What about entry fees?
If you're fishing for a profit with the intent to make a profit, yes, all your tournament entry fees would be deductible.
Well, that's the intent of every tournament, but the outcome is not the same.
Yeah.
Yep.
So yes, you could write those off.
What's the best way to keep track of all this?
We like to use QBO, QuickBooks Online.
Okay.
So we have professional fishermen that are clients of ours, and they're all over the country all year long. And what we do with them is we connect them to QuickBooks Online. We say, can you limit to 1 or 2 credit cards, 1 business checking account? We'll connect those to the software and it'll pull through all of their expenses. And if you can keep your personal expenses out, Christmas shopping or spas or alcohol, anything like that, if you can keep those off those business credit cards and business checking account, everything that comes through on that business credit card and business checking account, if those are business expenses, we've already got them.
Nice.
So when we get ready to do your tax return, we have everything we need.
Yeah.
So,
and even if you're not an LLC or any type of entity and you're just starting as a sole proprietor, you may not have a business account. So then what we might tell you, or at least advise you to think about doing, is just see if you can open another checking account, and exclusively use that for this sole proprietorship. And that just makes it a lot easier for you to keep track of all your business, income and expenses. And then once you get to tax time, you can look through that statement, that bank statement or credit card statement, and make sure, you haven't missed anything. Because if you don't have an accounting software like QuickBooks, then, people will potentially use an Excel spreadsheet or even just total things up and tally it on a piece of paper. But you want to make sure that you have a good paper trail and you're saving receipts. Not so much for the accountant, but just in case the IRS ever decided to audit you, you have proof, of your expenses.
Al with the American Angler Outdoors says, can you use a credit card statement as a receipt?
No.
Yeah.
It would be a receipt of payment, but it's not a receipt of what you purchased.
Okay.
Yeah. So like I said, the IRS, they're going to want to see the actual receipt, unfortunately.
Okay. So that can be difficult at times because, traveling all over,
Yes.
a lot of gas stations don't issue receipts.
Okay. Well, that is the exception, is gas.
Okay.
We don't need gas receipts, or you don't need to save your gas receipts.
Okay. And that's because of the mileage factor?
Well, even if you're taking actual expenses, they just don't force you to keep up with gas receipts.
Oh, okay.
Probably because it's so much.
Yes.
Guy Comp says, keep records of rod prices, reels, tackle, turtle tackle, hotels, boat maintenance, and fuel.
Yes.
Yeah.
Great advice.
That's great advice. And real quick, just to circle back to fuel, if you're talking about your automobile, we have one of two options. We talked about earlier the standard mileage deduction. We can also take what's called, the actual method, and that's where we would take the cost of the vehicle, the cost of the fuel, the cost of oil changes, repairs, and we would take that at the business percentage. So if it's a 100% business vehicle, then we're going to take 100% of the fuel, 100% of the cost of that vehicle, and depreciate it. Maybe it's only 50%. So that's why it's important to keep track of mileage and the actual expenses if possible. And that way you can kind of figure out what's going to be the better deduction for you.
Okay.
And along that same topic, you want to track your boat fuel separate from your automobile fuel, because we can take 100% of that boat fuel, and then maybe we're taking the standard mileage deduction on the automobile. So if you keep them separately, we can take both.
Mm-hmm.
Okay. So what you're saying is do two transactions for gas, one for the vehicle and one for the boat.
That would be helpful.
If the vehicle's not 100% business oriented.
Yes.
Even if it is, because depending on what type of vehicle you drive, we're probably going to take, as much as you guys travel, we'll probably take the standard mileage deduction.
Okay.
And the exception to that is if you've got a big, brand new, beautiful truck and you need to write it off 100% to offset some income somewhere else, then we may 179 it or bonus depreciate it that year.
Kevin McGibney has a couple questions. Where are you located and are you taking new clients?
Well, of course. We're always taking new clients, and we're located in Decatur, Texas. We serve clients all over the U.S. and some in Canada.
Yeah, and if you're from another state, we can set up a virtual meeting, but we're kind of outside of the DFW Metroplex. But yeah, we'd be happy to set up a consultation. And they have our website below, and at the end, we can give you our emails and other ways to contact us as well.
Now, I've had a couple times where I've changed rod sponsors, or I have a bunch of tackle and rods I'll donate to a local high school bass team. Do I just need a receipt from them, or how do you recommend do like a charity donation for that?
If you've already written the rods off, then you're not going to get to double dip for donating them. You've already expensed them. But if they're your personal rods and you do a donation, yes, get a receipt for that.
Okay.
And a pro fisherman would never have personal rods.
No.
Yeah, make sure to write all those off if you haven't, and you're a pro fisherman using them for business.
Oh yeah, I got spring cleaner once in a while. The wife would kill me, so I got to do that.
Yeah, and Rob says we don't spend that much money on fishing.
Right.
Nobody does.
No,
it's almost free.
I don't know if I made a mistake or not, but I gave the wife my password and login information for my bank account. So I don't know if I'll be in trouble next year.
It could be.
Uh-oh. Just keep your seats. Keep your seats.
Yes. Evan Perry says, great information. Thanks, Evan. Evan runs a tournament series up New York, Pennsylvania area. Boat fuel is must have receipt.
Yes. Yes on the boat fuel.
American Angler Outdoors says, I use the actual cost. What's the reason? That was the reason for my question. I lose most of my gas receipts.
Everybody does.
Yeah.
So nobody saves gas receipts. One thing you can do, especially if you're traveling, if you use the QuickBooks Online, you can take a picture with your phone. You know, if you go buy supplies, lay it on a table, take a picture, send it to this QBO email, and it'll connect to that transaction in QuickBooks. So you'll always have your receipts.
Now, isn't there a spot in QuickBooks that will, I believe it's linked up to your phone and it will keep track of mileage for you? You just have to designate it?
Yeah, it's pretty intense. I don't use it, but we do have clients that use that. So one thing, you know, we have a lot of clients that struggle to keep up with mileage on their vehicle. So your motor vehicle department will have your beginning and ending miles. You know, they'll have a record of that. So you want to make sure January 1st, write down your beginning miles. December 31st, write down your ending miles. If you drove 20,000 miles during the year and you know 90% of them is deductible, at least you have something. So, and the IRS will allow you, if you drive, which you guys don't, but if you drive the same route per month, every month you're basically driving the same business route, then you can track it just for 1 month. Or if you do the same route every single week, you can track it for 1 week and then extrapolate that to the year. So sometimes that's easier.
Okay.
All right. Another question about donating. Do I take the actual cost or the retail value on his taxes?
Typically we do about it's called the thrift value, which is that 33%, about a third.
Typically.
Now, is that retail?
Well, it's used retail. It's called thrift value.
Okay. So that 33% is off from actual retail. Yeah.
So if you had $1,000 rod and you donated it, maybe it was $350.
Okay.
So anything is it over 500, Nick, that needs an appraised?
Yeah. So, you know, if you're just donating one time in the year and it's less than $500, it's not really an issue to just not have a receipt. You know, you can claim up to that 500 non-cash donation, but as soon as you're getting to be above the 500, the IRS requires you to actually provide more information. So they're going to want to know, what was that thrift value? What exactly did you donate? And that'll be on one of the tax forms for non-cash donations. So that's why it's important to obviously get those receipts when you donate to a place like Goodwill or something. They should be able to provide you with some of that info.
Yeah. I know our local community programs, they do that, collecting clothing and stuff like that. You can bring it in, put your name and email on it, and they'll email you a receipt. So, which is nice.
Yeah, very nice.
All right. Jeremy May says he keeps getting packages from Tackle Warehouse.
For some reason.
Yeah, that means he's buying.
He's making last end of year business purchases. So that'll be a nice deduction.
This goes into the sponsorships and stuff like that. Should you issue 1099s, or do you issue 1099s to sponsors?
We don't issue 1099s for sponsors. We do for vendors.
Okay. All right. Jeff Fitz wants to know, you should be able to get a per diem deduction for every day over 80 miles from home.
There's not an actual miles from home. Nick, what is the?
So they have a per diem deduction for like full days away from home. You know, so if you're traveling for business and you're away from home for more than a full day, you can get that per diem deduction for meals and lodging. It's pretty good, actually. So you'd multiply, you know, if you're traveling fisherman and you're gone, 200 days of the year or something like that, if you're gone for those full days and you're traveling away from your main home, you can multiply that times the per diem rate. And that can be your deductible, like meals and travel per diem deduction. And oftentimes that's going to be a lot better than taking your actual meal expense as a deduction.
And Nick,
Gotcha.
on the meals, if they're self-employed, no per diem, correct? Or is that travel?
I think that, I'm sorry, I
lodging.
think that's just the travel lodging. The meal should be available for anyone that's
Okay.
self-employed.
I got you.
Okay, so no 1099.
Well,
Yeah, so the
1099s for any vendors that you pay. If you have a photographer or you pay a marketing person, you would 1099 them. Attorneys,
Okay.
CPAs.
Mhm. Yeah, the
I missed that
1099
question, Rob.
There you go.
QuickBooks is our friend. Yes.
Yeah, QuickBooks is great. We always tell people, like, even though maybe you have to pay $50 a month or $70 a month, however much, your subscription to QuickBooks is, in the long term, a lot of times it's going to save you money because you're kind of guaranteeing when you connect those business accounts that you're not going to accidentally miss an expense on the tax return. So that way you're making sure to pick up every expense, get every deduction that you can. Because obviously if you've got the expense, you don't want to get to tax time and forget to deduct it.
What about depreciation? Boat, trucks, trailers, things like that. How does that work?
Yeah, so that's a great question. It kind of depends on, with the vehicles like trucks, it's going to depend whether you decide to do that actual method or the standard mileage. Usually kind of a general rule of thumb would be if you have a more expensive vehicle, like a truck, for example, and maybe you don't drive quite as many miles throughout the year, a lot of times the actual method is going to be better, because you're going to get to depreciate that vehicle. So if you paid $70,000 for a truck, if the gross weight of the truck is over 6,000 pounds, you can actually write all of it off in the first year that it's placed into service, even if you are financing it. Even if you only put, $100 down and you're financing it, you could write it all off in 2024. If you bought it on December 30th, so that can be a great deduction if it's 100% business use. But if you have maybe a less expensive vehicle, maybe an older vehicle, and you drive a lot of miles, then oftentimes that standard mileage deduction is going to be a lot, better for you. So we can obviously look at it each way, but that's kind of how depreciating a truck would work. You'd either do actual method or you do standard mileage. With a boat, it's kind of a similar deduction where we can take that depreciation over 5 years, or we can do the section 179 where we accelerate some of that depreciation up front. So, a lot of times with clients who are self-employed and maybe they have a lot of income and they're in December, they're at this time of the year and they're like, man, I've made a lot of money this year. I don't have a whole lot of deductions, but I know that I need a new boat for next season, or I need a trailer for next, for the tournament season coming up next year. Well, maybe it makes more sense to buy that now before we get into 2025, because you can accelerate that write-off and you can take that in 2024, and you can take that on your 2024 tax return.
American Angler Outdoors says, is there a minimum for sending a 1099 out where you do it for any expenses or just over a certain amount?
Yeah, so for 1099s, if you pay someone over $600, then that's when you're going to need to issue the 1099. So if you paid, like Mitzi was saying, if you paid a CPA, or if you paid, even if you actually paid rent, you would issue a 1099 for the rent payments. If you paid any type of vendor over that $600, photographer, filmer, then you're going to want to send them a 1099.
Okay.
Okay.
And I put their email addresses up on the screen for you.
Oh, awesome.
So,
And I'll also say this about the 1099s. If they're an S corp, you don't have to send the 1099 unless they're an attorney.
Yeah, and actually, Mitzi, with the S corp, I was going to ask, have you guys ever heard of S corp? Because I wanted to kind of explain how creating that LLC actually eventually can possibly help you with taxes. It's a little bit of a more complex topic, but for those people who are in this for a business and maybe the business is starting to grow, this can be a great tax strategy if the audience would be interested.
Sure.
Awesome. So earlier I was saying that, creating an LLC doesn't really do you anything in terms of taxes. It's not really going to help you at the immediate moment. It's more so going to help you with that liability protection, things like that on the legal side. However, what you can do is once you've formed an LLC, later down the road, you can elect to have it taxed as an S corp. And so initially, when you set up a single member LLC, the IRS views that as a state entity, so they call it a disregarded entity, which basically means you're the same thing as a sole proprietor. So if you just started working for yourself and it was a side gig, you file your 1040 tax return with a Schedule C on it, and that's where you record all of your income and all those expenses. Once you set up the LLC, it actually works the same way. You keep filing that Schedule C, but at a certain point in time, and we usually would recommend that once your net income, so, once you've come up with all your expenses, once that net is more than 50,000, usually you're going to save taxes by electing to be taxed as an S corp. And the reason for that is because on that Schedule C, you guys may be familiar with this, but when you file this Schedule C on your taxes, they tax you in your normal federal income tax brackets, but then they tack on there something called self-employment tax. And that's the Social Security and Medicare. So you're paying at the highest point 15.3% just on that FICA, on that self-employment tax on your net income. And whenever you elect to be taxed as an S corp, you actually get to split your business's income into two different buckets. Some of it is still self-employed income, but then some of it gets to avoid that 15.3% self-employment tax. So that's a really great strategy once your business really takes off, and maybe once it's no longer a side gig, once this is your main gig and you're netting more than 50,000, then usually what we would advise is making sure you have your LLC, and then we file a form with the IRS so that we can have them tax it as an S corp.
Awesome.
Good point. Good point.
So for some people, Alvin with the American Angler Outdoors says, thank you. Gross and net, can you define them or give a good example of a difference?
Yeah, so gross is going to be what the 1099s say. Like, for example, if somebody sends you 1099s because they're sponsoring you, or you won at a tournament, you're going to get these 1099s in the mail most likely. Yep. That's typically going to be your gross. And a lot of times your gross is more than the sum of all your 1099s because you've gotten money from a lot of different avenues potentially. So the gross is that basically that dollar value of all the money that came in before any of your expenses. And then on your taxes, you're going to make sure we're going to itemize all your expenses: meals, travel, fuel, depreciation, home office, internet, cell phone, supplies, rods and reels. We're going to itemize all those as deductions, and you're going to get down to a net number. And that net income ultimately is what you're taxed on. So that's why coming up with your, maximizing your deductions, making sure you're not missing anything, that is going to be super important to avoid paying unnecessary tax that, you shouldn't be, paying. So. And
for fishermen, I was told that it's gross what falls through the net. So.
That's funny. Yeah.
Gross is above and the net's below.
I like that.
So that's the way it was explained to me, because for some reason I had a hard time deciphering the two of them.
Yeah, but I know like usually if I make below like 600, is that like the limit? Like if you win under 600, they don't usually send you something. It seems like over 600, they'll send me a like 1099 or whatever, like January.
Mm-hmm. Exactly. And Mitzi, one thing I know we wanted to mention, and maybe you can describe it a little better, but getting 1099s, sometimes if you're all over the US, you're getting 1099s from different states. And so it can potentially add a requirement to file these state tax returns. And maybe a lot of people don't realize that.
So each state will have its own requirements. Some states don't even have, like Texas doesn't have an income tax. New York, of course, has a big whopping income tax.
So, yeah, tell me about it.
But they will typically have a minimum amount of money that you have to make before you have to file. So if you're making $500 or $1,000 in a state, you're probably not going to have a filing requirement. But as your income grows state to state, you will have multiple state tax returns.
And a lot of
Yeah.
people think, hey, well, I live in Texas full time, so that means I don't file any state income tax. Well, not necessarily, because if you're doing a tournament in California and you win $30,000 in California, then California wants you to file that state tax return and pay them some tax on that $30,000 you won there, because that's where you earned it. So that's something that people don't always realize.
So what
And
you're
Nick-
saying is only fish in Texas.
Yes.
Exactly.
Where else would you want to fish?
True.
All
true.
over. Kevin McGinley says we'll be contacting you to possibly see if you would like to take our business on as a new client.
Thanks,
Great.
Kevin. Thanks, Kevin. Yeah, that sounds great.